banking on a turnaround is a big theme. There is lots of news in banking, some for the wrong and some for the right reasons. And not just the banks, I think the regulators are fashionable as well today. Thank you very much, Dr. Jalan, for joining us all the way from Delhi. I'd like to go across to him. Is he there with us? Okay. Thanks very much, everybody, for being here. Banking is perhaps the most important cog in the wheel if India has to get to a $5 trillion economy, if our economic turnaround has to be real, and if growth has to take off. There's got to be a credit flow. It's not just the banks anymore, it's the NBFCs who play an equally important role, and they've also been in the news a lot lately. Mr. Mehta has just come back from a meeting with the new, freshly minted RBI Governor, Shaktikanta Das. He said yesterday in his opening remarks when he met media very shortly that I'll be meeting heads of public sector banks. What is your biggest takeaway from the meeting you just had? If I may, are you breathing a sigh of relief that finally there's a channel of communication open with the regulator?
I was there in the meeting, and it was basically a welcome and a pleasantry exchange meeting because the governor has recently joined. So we have introduced ourselves, and the basic purpose is creating a dialogue between the regulator and the banking system.
And were any of the issues discussed?
No, it was just a general deliberations.
Okay, so we have someone who's just walked out from Min Street for this conclave and has met the new governor. Can I go across to Dr. Bimal Jalan? Okay, before I go across to him, Keki Mistry, is the worst of the financial crisis, the banking mess, what happened in the NBFCs in the last 2 months behind us?
I would certainly think so. September was a bad time. September, October, the nervousness in the market continued right through till October. But the fact that between September 20th or 21st, whenever the crisis really sort of erupted, till now, there has not been a single default by any NBFC, contrary to what people were talking about in September. That fact has instilled so much of confidence in people's minds that I think the confidence level today is significantly higher than what it was in September.
Fair point. I think I've got the line going with Dr. Bimal Jalan. And as former RBI governor, sir, I have to ask you, what does the appointment of a new man mean for the banking sector, the financial sector? And I'll perhaps repeat my first question. Is the worst of what we saw in NBFCs and the banking sector, mounting NPAs and all of that behind us?
Behind us may be too strong a word, but I think two actions taken by government on the Bureaucracy and Insolvency Act at the request of RBI, as well as the prompt active action or prompt action to try and reduce the default on the banking loans, etc., by the RBI. These are two very positive moves, and I am sure that, but you have to give it time, that in a few months' time, that whole NPA issue would start reversing.
Okay, fair point indeed. Rashesh Shah, I'll get down to specific issues about NBFCs in just a bit, but I do want to touch about some of the banking issues that are in the public domain and seemingly were also the big bones of contention between the RBI and the government playing out in the public domain. Let me begin with one such issue, and Mr. Mehta, I'd like you to add to this before I go across to Mr. Dubashi. There is this debate that PCA norms need to be reviewed, PCA norms need to be looked at. There are 11 public sector banks under the PCA. You know, an economist will tell you you can't lend yourself, lend your way yourself out of a crisis. There's a reason why these banks are there. I know the argument to be made on the other side is that they're flushed with deposits. You might as well make them lend. What is your view on this, really? Let Mr. Rashesh Shah take it, and Mr. Mehta, I come to you next.
Yeah, it's an important question. I think we need to have some kind of a framework around how do we deal with this. Because what happens normally is when a bank's asset quality gets impaired, automatically the deposits will slow down coming into the banks and all, and there is an automatic slowdown that happens. Strangely in India, because these are government banks, so there is no risk issue in those banks. So even if the assets, there's a high NPA, the deposits keep on flowing. So I think having a very standardized, rule-based kind of PCA for all the banks, what a lot of experts believe we need to do is have a very customized approach. There are only 11 banks, because there are some banks who have cleaned up the mess but now need to grow their way out of it, because you clean up and then after some time, if you have the deposits on the other side, you should be able to lend and grow your way out of that. There are some others who need an equity infusion. Some others may need to do asset sales also. So I think for each of these 11, there should be a very customized, a very individualized kind of a plan, rather than have one standard, PCA norm saying all of you can't do A, B, C, D. You can only give, loans for A category and above. I don't think it's a big ask, and I think that is what I've heard. At least the conversation has been not that they should start giving credit in the old fashion again, but can we look at the PCA norms and review them and see whether there can be some changes that can be made.
Fair point. But let me be the devil's advocate and give the other side of the argument. And Mr. Mehta, this is really for you. And I'm going to quote former central banker Y.V. Reddy here. And he once said that the way to get out weak banks is not to shut them down or to make them fail. You shrink balance sheets. And PCA perhaps is aimed at doing that. When you say banks are flush with deposits, some of them can find their way out of lending. In any case, there are too many banks in India. We're looking at mergers. Is shrinking of balance sheets not the right thing to do? Because people will turn around and say, when you ask for a review of PCA, you're going back to the era where banks were blamed for relooking the other way when crisis was mounting.
I think I'd like to give you a different perspective about it.
Sure.
All the banking system in India is basically a repository of the trust of the people. They have kept their deposits with them. And RBI as a regulator has a right to take prompt corrective actions when they find there is certain deteriorations in the balance sheets. There are important issues. One thing, this issue has been blown out of the proportion in some of the ways that none of the bank even in PCX, barring one or two, is being restricted in lending to the MSME sector, the retail sector. And the another way of looking at it is, if you want to improve your asset quality, there is an option available for churning of the portfolio. So it is basically managing your risk-weighted assets. You cannot take your, nowhere the RBI has said that they cannot participate in quality lending. They can always lend to the A-rated, AA-rated, AAA-rated accounts. So that option is always available to all the lenders, barring one or two cases where the specific, they are the stage 3 of the PCA. Other lenders, these options are available. So such type of things, this can give some scope for the individual bank to replan their portfolio, increase their quality lending into the less risk-weighted asset, take exit from a high-risk weighted assets, improve their recovery performance, in a process can improve the health of the banking system. So I do not say the PCA framework is irrelevant. It is definitely relevant. Now, I'll agree to Rashish ji that it need not be applied in a uniform way, case-to-case basis. There can be certain deviations that can be permitted, and I think everybody is deliberating on these issues.
I just don't know if that brings in the amount of discretion, but let me get a word in from former central banker Bimal Jalan. And Dr. Jalan, what is your view on this really? As far as PCA norms are concerned, should there be a case-by-case review of the banks under PCA, or do you believe this sort of a review is not warranted at a time when we're just about to and beginning to clean up the mess in the banking sector, and we perhaps need to shrink balance sheets?
No, I don't think, no, but I don't think there can be two opinions on it, which is that yes, it should vary from bank to bank. I mean, that is what prompt corrective action is about. That if you are taking action to take care of the outstanding NPAs in a positive way, then you don't have to apply anything more to that. Just keep on regulating or keep on watching what's happening. And the general rule should be just one, that reduce if your NPAs are higher than what should be, you have to reduce your balance, you have to correct your balance sheet issues, and lending issues have to be better. But it can vary from bank to bank. On that, there can be no two views.
Okay,
in terms
so it
of
has
timing,
to be
whether you do it on,
fair point. A case-to-case review is perhaps warranted, and the panel kind of has a consensus on that.
Where each bank is going. Yeah.
Fair point. Mr. Dubashi, let me come to you, and I'm going to just take a break away from banks. We'll go back to them and talk about NBFCs. And I think the big debate is on liquidity. There are people who will turn around and say, is the debate fair to be on liquidity, or is this actually an insolvency debate? And I think ILFS kind of triggers that side of the argument. Is the worst of the liquidity crisis for NBFCs behind us?
Okay, so let me just put it in perspective. This whole, NBFCs also file their liquidity statements. There is RBI norm which says minus 15% is allowed. It can always be reviewed and said, okay, 0 is allowed or some positive is required. I don't think it is the issue which is across the board. There were NBFCs which were always keeping positive gaps. The issue started with a misunderstanding that ILFS issue is a NBFC issue. ILFS is a NBFC in letter, but not in spirit. The ILFS in spirit perhaps is more of an infrastructure developer than an NBFC itself, right? Coming to a specific question of whether it's a capital adequacy issue or a liquidity issue, I would think it is the issue of confidence that happened because of ILFS. The capital adequacy of NBFCs is quite good across the board. Liquidity, barring a few HFCs perhaps, who are funding long-term assets by, and very few, there was no issue. But when ILFS happened, those 15 to 20 days, when the entire NBFC sector came under cloud and mutual funds said, we will just not do anything from 21st September to say about 10th of October. So it was very transitional. It was more an issue of confidence than any other real issue. And as time has gone, we have seen that it is very transitional. And as Keki rightly said, maybe the worst is absolutely behind us. So I really wonder whether it was a real issue or there's just an issue of confidence.
Mr. Mistry, are you going to be as dismissive? This was just a transient sort of a fear that engulfed the NBFC space, and now we should all be confident that there's nothing quite wrong there, because a lot of people out there and people of eminence have voiced concerns on there could be more NPAs in the making that will eventually have a toll in the banking space as far as NBFCs are concerned.
I think to understand really what happened with the NBFCs, you have to go back into the last 4, 5, 6 years. There was so much of optimism, there was so much of euphoria in the market that there were a whole number of new NBFCs and housing finance companies that were set up during this period. And many, not all, but many of these NBFCs were set up with the primary objective of valuation. So the whole focus of the company was how to grow fast, how to record a 30, 40, 50% growth, and in that process get a rich valuation. In the process of growth, some of the risk management systems were not appropriately followed. And short-term money was used to give long-term loans. Not by everyone, it's not by everyone, by a few players. Then ILFS happened, and this went on for a while. This went on for a long period of time. And even though it was short-term money, because there was so much liquidity in the system, the commercial paper, most of these borrowings were to commercial paper. The commercial paper kept getting rolled over, and therefore, even though it was short-term borrowing, in reality, it turned out to be for a long period of time. And then ILFS happened. And because ILFS happened, it just created a lot of nervousness or lack of confidence in the market, as Mr. Bashi said. And around that time, the analysts started preparing reports and coming out with case studies of the top 100 NBFCs or the top 200 NBFCs and pointing out what kind of leverage they were carrying and what kind of short-term funding they were using to create their assets. And that created panic in the market. So I think the panic continued for a while. I mentioned earlier that because of the last 2.5 odd months that all the CPs that have matured have all got honored, the confidence has come back. A significant part of the confidence has come back. So I would say the worst is over. It was a crisis of confidence. To a great extent, it was a crisis of confidence. But yes, there was also a fair bit of short-term funding that had been used during this period.
Rashesh, I'm going to come to you, Mr. Shah. I think the reason why I'm asking you this question is because I think Arvind Subramanian here in the India Economic Conclave joined us yesterday, and he said, we must look at doing an AQR for NBFCs like it was done for banking. Now, I don't know if some of us agree or disagree with him. The reason why I'm voicing that is, and I'm one of the people who believes that if there is something that's going to spook markets, or if there is something that is, that is going to be seemingly so uncomfortable, it might as well come out. do you believe there's merit in the argument that there should be an AQR for NBFCs? And the reason why I also ask that question is that AQR for banks actually prompted the political will for cleanup.
No, I think it's an important question, but actually I must also add one other thing. All of us in the industry are happy that this stress test in real world happened too, because I think if it had gone on for another year or two, as Keki was saying, maybe the imbalances would have got exaggerated. So I think it's a good time. The stress test happened for about 4 or 5 weeks. I think everybody came out okay. It was, everybody's ALM assumptions got tested. So I think it was good from time to time to have this kind of stress test, provided there is no big accident that comes out of it. I think actually NBFCs go through AQR. All the systematically important NBFCs, there is a very rigid, strong, rigorous RBI inspection that happens every year on the asset quality. We use the word AQR very loosely, but because of our ARC, I was also involved when the AQR process was going on. The AQR process happened for one reason only, was because of consortium in banking. What was happening at that time is a particular account was classified as NPA by one bank, but 18 other banks who had exposure to the same account, because in banks there is consortium concept. In NBFC, you rarely find consortium concept. So the need for AQRs is saying, if L&T is calling something an NPA, why is Edelweiss not calling it an NPA? And that was AQR. AQR was not an inspection of the books. Inspection of the books is happening every year. Every year RBI is saying, why is this account standard? Why is this not like that? And they issue a strong report on that, which is presented to the board. The board has to debate the report on individual accounts that they point out. So there is an asset quality inspection that happens every year. But AQR will be an industry-wide phenomena if there is a lot of consortium oriented concept, which is not there in NBFCs.
So that's the difference between the banking and the space. But Mr. Mehta, if I may take the AQR argument forward, all right, it's done by separate entities. This is not a consortium like it is in banking and doesn't need to be done so stringently. But does an ILFS-like case stoke the debate for perhaps reviewing the regulating framework, the regulatory framework, or NBFCs? And that's a question I want all of you to answer. Let me just begin with you, because I think a lot of banks turn around and tell us, at least off the record, we are under such stringent regime, but the NBFCs, our other cousins, get away with a lot more. So let's just get this out of the way.
One thing I will definitely subscribe is regulation is always good for the system, because the regulation defines the between an ethical player and a non-ethical player and the better asset quality. And asset quality review should not be external. It should be internalized by each and every financial institution, may it be NBFC or the bank, for making a proper presentation about their asset quality and the books into their financial account, so that the people who are giving deposits to them, who are investing into their commercial papers, who are investing into their NCDs, they get a comfort that the quality of the assets and the portfolio these institutions are having are dependable and investable. So asset quality review should be internalized. That is a necessary, and better regulation will improve sustenance of those which are performing on an ethical basis, which are performing on a transparent basis, and this will definitely weed out those who are little less ethical and not doing this. So I think it's a good thing, but because in the market sector, there has to be differentiation between efficient and more transparent organizations and the organizations, the institutions which are not doing so good in it.
Mr. Mistry, can I ask you the same question? This regulatory framework, and one of the things that's said about regulation of NBFCs is that there are certain entities regulated by the RBI, the housing NBFCs don't come under that. Is there a wider sort of an umbrella regulation that's required? I mean, I know one hates the regulatory word, so to say, an excess regulation not warranted.
No, I don't think that's the point. I think it's a misconception that the housing, you're talking of housing finance, that housing finance companies are not regulated stringently. That's absolutely incorrect. I'm sure Mr. Mehta will bear out what is done with PNB Housing. There is a very intense regulatory inspection that takes place every single year. And the regulators spend a lot of time, not just at the corporate office, not just looking at accounts, but also looking at a whole host of other factors, including regulatory compliances and stuff like that. Now, when you look at regulation, there are stringent regulations. There are regulations which govern how you accept deposits, what kind of deposits you accept, how you classify your assets, when do you classify your assets as a non-performing loan, when you can accrue income, when you cannot accrue income, what kind of loans you can give, what kind of brokerages you can pay, and stuff like that. So it is a very, it is stringent regulation. I agree with Rasesh completely when he says that in a bank, there is consortium lending. In a housing finance company, you are largely giving loans to individual borrowers. Most NBFCs or most housing finance companies give about 65 to 70% of the value of the property as a loan. Now, if you're given 65, 70% as the value of the loan, there is a huge equity that the individual has in the property upfront, number one. Number two, the loan is always repaid through equated monthly installments which start the moment the loan is fully disbursed. So there is a principal repayment that keeps happening every month. And because of principal repayment, the outstanding amount of the loan keeps declining with every passing month. So, and the inspection that is carried out by the National Housing Bank in the case of housing finance companies, and I'm also sure by RBI in case of NBFC, so I don't know the how stringent that is more than adequate to be able to take care of any asset quality issues that may come up or any regulatory.
You'd like to add to that in terms of an overarching regulation? Mr. Misri says it's stringent for housing finance. There are no issues to worry there. I'm just saying, is there something more umbrella-like required? Mr. Shah?
I think what we need is to use a crisis like this. So if you remember when, the MFI crisis happened, the microfinance, then MFIN became an SRO, RBI came up with guidelines, and I think that allowed the growth to even become stronger. I think we should not let this, whatever short-term crisis that we had, go to waste. And there is need to streamline something. We need a very proper framework for NBFCs, not just on asset side, but asset, liabilities. If there is an NBFC, housing finance company in the same group, how do you do that? So I think there is some need for developing a framework. I think, as you earlier asked, I think on asset quality, as I said, there is stringent inspection that goes on, but also remember most of the NBFCs and housing finance companies have gone through a cycle of NPA recognition from 180 days to 90 days. And still the NPA average is half of the banking sector NPAs. Two, we have actually moved to Ind-AS in this year, where they actually the provisioning needs are much more stringent on asset by asset basis. And thirdly, the average gearing for NBFC housing finance companies is about between 5 to 8 times. And at this level of gearing, and the kind of granularity of a lot of asset quality, I don't think the problem is as big as it was in banks in 13-14, where there was almost 10-15% in some of the banks, NPAs in a few banks.
Fair point. But on that note, thank you each one of you for being with us, and Dr. Jalan for joining us from Delhi. The key takeaway really is that for a meaningful economic turnaround to happen, for India to get to a $5 trillion economy mark, it cannot happen without the missing link of banking or NBFCs and the lending space. Any amount of credit growth obviously is a reflection of more robust economic growth, economic activity. And on that, let's keep our fingers crossed and hope that the 12% credit growth actually offtakes and reaches the heady highs of 20% before we can break out of the 7% zone of growth. Thank you very much.